In the previous video, we looked at a few points that helped us understand a business. No matter how attractive the business looks, the number should be attractive too. So let's see which numbers we need to focus on. All of these will be available in the balance sheet released by the companies every year. Number 1. Revenue and PAT. For any business to grow, it is a necessity for its revenue and profits to grow year after year. So jot down the revenue and profit after tax for at least last 5 years and check how it has grown. Calculate the percentage increase year after year. A greater than 10% increase in revenue and profits every year is a good sign, and it shows that the company has been growing consistently for the last 5 years. Number 2. Earnings per share. Earnings per share is used to demonstrate the profitability of a company on a per share basis. We have made a separate video on this. Make sure to watch it for better understanding. Like revenue and PAT, earnings per share should increase every year. Profit and EPS are directly related. So if profits are increasing but the EPS is decreasing, then it means that the company is diluting the funds by increasing the number of shares, which is not a good thing. Number 3. Gross profit margin. Gross profit is net sales minus cost of goods sold. Here, cost of goods sold is the money that is required to manufacture a product. So gross profit is nothing but the difference between cost of production and selling price. Gross profit margin is gross profit divided by net sales. A high gross profit margin indicates that the company has a premium spot in the market or the operational efficiency of the company is excellent, both of which are a good news. Gross profit margin should be greater than 20% year after year. Number 4. Debt. One of the most important items that we need to pay attention at on the balance sheet is the debt. An increasingly high level of debt indicates a high degree of financial leverage. Growth at the cost of financial leverage is quite dangerous. Also, a large debt on balance sheet means a large financial cost charge. This eats into the retained earnings of the firm. Select companies that have maintained or reduced their debt consistently. Number 5. Sales versus receivables. Receivables are a part of net sales. Receivables means selling goods or services on credit, which is generally not a good thing. So if the net sales has a high percentage of receivables in it, then it's a red flag. The percent of receivables in net sales should be lower than 20% and should decrease or stay stable every year. Number 6. Cash flow from operations. This is one of the most important checks before you decide to invest in any company. Cash flow from operations should be positive for at least the last 5 years. Number 7. Return on equity or return on net asset. Return on equity (ROE) is the percentage of return generated by the company, keeping the shareholders' equity in perspective. ROE measures how successful the company's promoters are for having invested their own funds in the company. Try to invest in companies that have achieved more than 20% ROE for the last 5 years. After going through step 1 and 2, if you are sure that this is the stock you want to invest into, then you need to start thinking about the price you should pay for buying that stock. We will be seeing this in the next video. See you there. Thanks a lot for watching this video. Do like and subscribe to show your support. We'll keep making more videos on earning, saving and investing money. One stop to all your money problems. See you in the next video.